Thanks, Laura, for inviting me to your beautiful office. It's a lovely location and fortunately great weather today. So I think today the idea is to talk about various tools and techniques that we use in wealth management and where it's progressing. So perhaps maybe you could introduce what LENSELL does and yourself as well.
Sure. Very nice to have you here. So LENSELL is a research-driven investment technology platform where we build technology for experienced investors and investment professionals who want to make better decisions with insights and technology. Our main application is Diversification, which is a portfolio analysis and optimization software where we allow people to see their current expectation of performance from their investment portfolios and then identify potential improvements that they can make from an allocation perspective, from diversification perspective, and then we help them calculate those allocations or make those changes. Without giving advice, we give them the tools so they can do this themselves. And we currently cover listed securities like stocks, ETFs, bonds, all listed securities from 8 major markets and also all mutual funds from India. Because we want to address investors and professionals who have diversified portfolios internationally, this being one way of diversifying your portfolio. We want to have a global platform where we collaborate with professionals from different countries, like yourself, to help, again, investors from different countries make investments in all sorts of products.
Lovely. So it's a technology layer on top of, let's say, a wealth management firm, where advisors can leverage it to truly enhance their tech stack or optimize and diversify, right?
Yes. So, of course, investment professionals do their own, job, which they are trained and experienced in, and we bring the technology to make their life easier. Help them run portfolio scenarios faster, identify options for their clients, so they can give their clients the best, advice.
Right.
Technology.
Perfect. Right. So essentially, FinSharpe, we're a SEBI registered investment advisory. So we create long-term investment portfolios using quantitative analysis. So we do use various quant steps where, let's say, we're taking raw data from the exchange, we're converting it into actionable insights, FinSharpe insights, and ultimately we create an investment portfolio and manage the entire client's fund end to end. So that's what we do. And I think a year and a half ago we started with this pilot project where we wanted to see how we could leverage FinSharpe's analytics and LENSELL's tech to create investment portfolios. And markets, have been quite volatile past few months, and that was a good test of time.
Good test, yeah.
Whether these things that we're trying to do are working or not, whether quant in general works in volatile markets, and that's a good assessment, a good case study that we have to present.
Yeah.
But I'll just take one step back before that and sort of try to understand why quants, right? I mean, what's the pros and cons of what we do? And maybe I can go with some and then you can add on what you feel, right? So I believe investing is very straightforward, but it's very difficult to execute because of your psychological biases, right? You may have a certain portfolio of stocks. You may feel that, let's say you use a brand, you use a car, and the stock is publicly listed, right? You would always have a bias towards it.
Yeah.
And there's nothing essentially wrong with the product, but it may not be the right time for the stock. So how much weight do you allocate, or whether or not do you pick that stock or a competitor, right? There are so many personal biases that come into investment decision making, and quants or any systematic approach just helps us sort of reduce these biases. And that's why I prefer having a rule-driven or system-driven process where I don't have to have opinions about the market or projections. And analytics, right? Portfolio analytics truly come into play. So that's what we do at the core at FinSharpe, and I believe what you're trying to enable as well.
Yes. So like matching what you said, often people make decisions to invest or buy or sell something just based on different advice that they see online from their friends or family, or like you said, maybe they just like a stock and they heard so many things about what maybe that stock or that ETF or whatever product is, maybe it's not as good for themselves. from a maybe risk tolerance perspective, maybe as that stock works with other investments they have. So there are many things to consider. And what we, like you do with analytics, we want to take that emotion out and give people that insight based on data. This is why we call it data-driven, research-driven. So based on real, proved technologies or insight from the past or newer technologies, to make decision without so much emotion, either fear or greed or anything else, but have been more factual informed decisions.
Absolutely. So coming to, let's say, what we do, right, and probably presenting the case study that we worked on. Essentially, there are two steps in creating a portfolio. One is your stock picking research, or what we call as ranking. And the next part is the allocation. How much money to allocate in which stock, right? I mean, of course, this is really shorting down to the niche of portfolio creation. There's many steps before and after that. Let's say it always begins with the financial goal that you have and your risk tolerance and profile and whatnot, right? And then you come to this. But since we are catering to the analytics of the portfolio and creation, we'll speak more about that. So maybe I'll start with the ranking part of things, and then you can throw some light on how allocation really makes a difference. So in ranking or stock picking, you could have two verticals to it. One is, let's say, qualitative, and one is quantitative. So let's say in a qualitative sort of stock picking, you may look at the business module of the company, promoter vision, certain management, right? And let's say if there is any macro news going on, or let's say a government policy, various other things, right? Which you cannot put a number on, which is a little bit subjective as well. But if you get it right in the long term, right, you get the stock picks right, you can make a lot of money. So in qualitative, these are the ways to do it typically, or maybe you go on ground and check the sales of a company and various other things. That's one vertical. Second vertical is quantitative, right? You just let the data speak, right? You analyze fundamental pricing, volume, all sort of data, and essentially harvest some ratios and key insights from this data, and then do your stock picking at, let's say, regular intervals. That's primarily what we do at FinSharpe, and with one strategy that we experimented on. That strategy was focused on the mid and small cap category of stocks, where what we essentially did is that we broke down those categories in 4 factors: value, quality, growth, and momentum. Essentially, each and every factor has sub-ratios in it. For example, let's take momentum as a factor. We're looking at different periods of returns, quantiles, we're looking at different linear regressions, then multi-period momentum, slope of, let's say, the movement of the stock, various other things on different time frames, and selecting the most suitable and appropriate for that kind of universe. For example, if you look at, let's say, a large cap or a really large company, you wouldn't want to base the decision on really short-term performance, because typically those companies won't move that much. But when you come to the small caps, they move very fast, so you would have to reduce your look-back window much shorter, or a smaller look-back period. So on and so forth, we build different factors, and we then shortlist the entire mid and small cap category stocks into an investable universe, and then pick, let's say, the top 25 or 30 stocks. And based on each factor, we have a proprietary weightage given to each factor. So ultimately, the stocks that we get are a mixture of fundamentally strong stocks that are in momentum, stocks that may have a little bit lesser risk to sort of balance out the portfolio risk. And that's what we did. And then we essentially took that and gave it to you, and said, okay, perhaps you can use LENSELL's analytics on top of what we shortlisted. So over to you.
Yes. First, I just wanted to add to what you said, that it's a lot of work in all this, finding all these factors first, knowing about them, but also calculating. And so this is why, users, unless they are very experienced to do it with themselves, have to go to a registered advisor, or use tools also of advisor using technology to give this advice. Because unfortunately, there are advisors who just give based on their best understanding, but not using technology, so they will have less data-driven insight.
Absolutely. And I think now with AI, being out there, it can really assist you in stock research. The tools that were not earlier available are available now, but you really need to know what to ask it.
Yes.
So prompt engineering and asking the right things. For example, let's say you go and ask ChatGPT that tell me the next multi-bagger stock, right? Maybe that's not the best way to interact with it. Or let's say tell me top performing stocks of the past 1 year, and that's what I'm going to invest in, right? That's not the right way to go about it. Even while asking or doing your research, it has to be very structured. So essentially, you need to ask it the right things, like let's say, tell me about the fundamentals of this company, overlap technicals and pivot levels on it, and then
it's not something that anyone will know to ask us.
Absolutely.
But if we make a comparison, many people use Google to find about their illnesses and diseases and everything. You better go to a specialized doctor who can help you.
Right.
So in this case, you go to a specialist who can help you with specialized information. But you put time to get out, so you can help your clients.
Right.
So the second step in this, as you said, there are not just these two steps, there are a lot of work around it, but stock selection and then how you allocate is very critical, how the portfolio will perform. So what we do is look at the allocation again from a data-driven perspective, because each stock will have its own, expectation of return and volatility, and so that composition is not easy to calculate, as and we use technology based on all the research of model portfolio theory to come up with all this universe of potential allocations and looking at what each of these allocation will give you, and then selecting those which are efficient, like efficient frontier, optimal portfolio, minimum risk, depending what you want to achieve.
Right.
So in this case study, we looked at the list of stocks that you provided, and we calculated the optimal portfolio in February 2024. And identify that optimal allocation, and then used it for progression of portfolio value. So as you can see in the case study, it gives a better maybe portfolio value in time compared with the original one. And we will note that we haven't optimized again. So of course in real life you will do some other rebalancing and other optimization at some intervals were required. This was just a case study to show how things compared. So we just optimized in February 2024. But it proves the power again of using technology, because if you try to do this for more than 20 stocks yourself, it's really humanly impossible to calculate all these potential allocations. So this is where technology can help professional as well, doing things faster for their clients.
Right, absolutely. So I think some key points from this, which I'd like to highlight are essentially, if you see that the experiment that we did, the portfolio fell down in 6 months, right? Of course, it's not a magic wand where it's sort of, it's going to do the, when the markets are bleeding and the portfolio is going to go red. But the important point here is that even a 1% return compounded, right, over a 10-year period is going to make a huge difference. If you're able to use technology to your assistance to even get that sort of 2% CAGR extra by optimizing it, it makes a huge difference. And in this particular case study, we've seen a drastic difference, right? Now, obviously, as you mentioned, that there are certain other steps in terms of risk management which you need to add on top of this, which is doing it at a regular period or as and when needed. At least I would say have a look at it monthly or quarterly if it's a volatile strategy, or then you can move to semi-annually if it's a multi-asset. At least to have a look at things, and it really depends on what is the sort of volatility of the base universe. But
one point we also want to make is, because these times are very volatile in Australia and India, everywhere, we saw that the optimized portfolio, as you said, doesn't go up, of course, with the market. Still goes down, but it goes down from a better position previous to the downfall. So in the end, you are still better placed. So it's still, a very good position to be in, even if markets went down for 2, 3, 5 months.
Right. So again, the beauty of it is that no matter what technique you used for picking the stocks. If you were just a little bit better at having the right weightages, right? It would make a significant difference in your personal finances, right?
Sure.
And this, if you look back and sort of look at your existing portfolios, right? The questions that you need to ask yourself are: is this portfolio doing what it's supposed to do?
The best it could be.
Right? Is it the best it could be? Because a penny saved is a penny earned, right? So is it happening? If not, what can be done, right? On top of it, the bare minimum is first, let's say, absolutely, I'm saying that you have to go to an investor advisor to be able to get the best of best. But let's say you were to do it by yourself, right? Then you can do certain things. And again, the two techs that investors and people watching this can leverage are, okay, so we have built an AI-based framework where you can come and research about any stock. Okay, so let's say you put with using human language, you analyze, let's say, tell me about Tata Motors and help me analyze the stock Tata Motors. So we'd be giving you different analytics which would otherwise be difficult to process using fundamental data and pricing data, which these large language models don't have historically as of now. It may happen in future. You do that, you research the stocks, create a portfolio, select it, perhaps take that, and then come to, let's say, your platform, where they could allocate some weightages towards it and monitor and track it.
Right? The next step, and also look at diversification. Maybe if you may be passionate about stocks in a certain field, you may be going very focused on that area, but you may want to diversify, as you saw in these volatile times. It's good to be diversified. So there are many things you can do, again, with insight that these technologies provide, and make better decisions based on that information.
Right, and I think the current beauty of LENSELL's tech is having a global view on different markets. So that's one feature that that stands out. And if you are an investor who's investing in multiple markets, then probably that can become a one-stop platform. We're more focused towards the Indian markets. So if you want to invest in the Indian markets where you want the end-to-end management of picking the stocks, doing the risk management, and then making adjustments as per your financial needs, then we have that entire suite ready from A to Z. So our goal is to have a platform to cover different markets, because with all this globalization of movements, people move for studies, for work, for anything from one country to another. They still want to invest, like people of Indian origin, Australia, they still want to invest in India, so they need that advice and access to the products, because those are the companies they know better or they are aware of. But they may also want to invest in Australia or US or other countries, so it's good from a technology perspective. It's doable, so this is what we want to do. And also I think it's very important to have that local advice like you provide for the Indian market, because an Australian advisor will not be able to give advice on Indian stocks, even if they use AI, because there are still localizations, sort of things that you need to consider. So I think using both technologies can be very helpful to someone. And I think one feature that LENSELL would be providing in the future is a marketplace where different countries you'll have different advisors or experts for different markets. So someone in Australia who, let's say, has exposure to any other market or would like to have exposure, you give them the tech and the best of both, and the human advice as well, right? So you have a human who you can interact with, ask your personal questions, and leverage your technology. So the best of both worlds, right? That's what
this is what we want to have, and we started working on that, having, like you said, the advice from a local market, because those people know better, and then the technology can be across markets, because that's agnostic sort of. So
absolutely,
this is what we work towards, to cover more major markets for investors who want to be internationally diversified.
Right. So one question or other, one topic that we must touch upon is AI, right? AI in portfolio analytics, in wealth management, in finance, and we're seeing n number of applications and whatnot, but it's not there yet. As as practitioners, right? how much do you use it in daily life? I mean, you may use it to write code, to sort of,
ask questions.
to ask questions, right, and to get that. But to what extent? So, what's your opinion? What's your take in what's happening with AI? And let's say, do you see? How can investors benefit, or actually, how could it harm them in some ways in terms of actual portfolio analytics and investments?
So I think we are not at the time yet, maybe in some time in future, but now we are not at the time where you can click a button and get the perfect portfolio or the perfect advice or everything. So there is no AI, yet agent or platform, LLM or whatever, to replace the advisor. The same way there is no AI to replace the doctor, medical doctor. So I think AI now, because it started with LLMs, with summarization of very large amounts of information, documents and so on, it's really good and helpful in finding information faster, summarizing, getting access to so many things on the internet that are publicly available in seconds. At the same time, as we saw, if generative AI makes other people's life easier, writing or creating images or text or anything else. But from a perspective of analytics, while they can become components in AI agents, and make your own sort of step-by-step analytics, first it requires very specialized knowledge. Like you said earlier, you need to know what you ask to do.
Right.
So it's very useful for people who have a background and experience. But for regular investors, going there and just asking what should I invest tomorrow and how should I combine them, that's not the tool, that's not the place, because it's not. I'm not sure if it will ever get there. Maybe it will, but for now, I think it's a helpful tool. It's not something to replace the human in all this investment process. It will replace some steps. Maybe you can do trades faster. Maybe you can do, like you said, maybe some steps in your research could be done faster. Spending minutes instead of hours, maybe.
Right.
But doing the entire work and considering your like you said, your goals and your risk tolerance and everything, and having understanding. This is why actually people prefer going to advisors, have a human relationship, because there is a trust component as well, which AI cannot give you.
Absolutely.
You could trust the data or information, but you also want that element of relationship. So it's very complex. It's not really, we build technology. I cannot say technology is not good, but it's good in a way that you use it to do best yourself or best decisions, not replace yourself.
Right, I fully agree. So in fact, I have a client, a few clients now that AI has started coming up, right? So a funny interaction that I have now, one of our clients, or most of them are really very tech savvy and they come from premier institutions. So what happened was with one client, let's say the client was asking me our investment approach. So I told the client, okay, this is what we do. Then the client used those prompts to go on ChatGPT, create a portfolio, and then said, okay, is this how you do it? So I said, wow, there's some parts of this, some of it. Then he created an investment portfolio, and he asked me to analyze it. So which I did, right? And I noticed that yes, as you said, some steps in the process can be changed. And the client was actually very diligent about even the prompts, tech savvy client, right?
Yeah.
So he did everything, and then finally said that, okay, so I would like for you to manage my portfolio.
Yes. Back to a specialist.
Come back to square one. But the idea being that yes, today there is a lot of information in the hands of retail investors, of everyone, right? And there's a lot of capabilities which anyone and everyone can leverage, but the final decision making, right, or the final let's say shot is wherever there are experts and consultants, where the stakes are high. The trust component, it will take some more time, and it may not be there yet, I think, but definitely in terms of portfolio analytics, in terms of various other things, the agentic framework, right? You can build different agents for different processes and then combine it into one. So earlier that, a company would require, let's say, hundreds of employees just to do a certain research. Today, it may not be so.
Yeah, true.
But there are certain professions where completely replacing a human seems a little bit far-fetched as of now. Again, we can't say anything about the future, but I agree. I think in the case studies that I have seen, even if there is superior technology, right, in case it does not work in your favor, you would really be skeptical about it, right? And as you said, that does even the best perfect portfolio exist, right? So the question that everyone has, that if everyone starts using it and everyone follows the same stocks, now they're going to get more crowded, eventually get everyone will have the same portfolio, and then it gets overvalued. Then what's left, right? So, I mean,
I think it's always there is so much information at the same time. Because there is so much information, we have less information because we are exposed to so much online that you can only grasp a bit. So then we cannot say, I cannot say I know as much as you, and cannot say so it's everyone has their own experience, background, and things that they process every day. So their experience grows with that. So we are all different, so we'll build things differently, even if technology, because the problems I'll ask will be different from your problems. So we'll but as I said, I think it's a good tool, but we shouldn't get too much into just technology.
Right, and absolutely. And one point that you mentioned, that every LLM is sort of trying to differentiate between how their reasoning model works or how their models work. So if you ask the exact same prompt for, let's say, portfolio creation and analytic across different models, right, it's going to probably give you a different output. Right now, then if you have too many options, you again come back to square one.
So which one I choose?
Which one do I choose, right?
True.
So you would still need, let's say, an advisor. And what we're saying is that the tech that we've built, right, it's so accessible that, and we're using, so when these models become better, our tech becomes better, and it'll help investors make better decisions. But essentially, now is the time for investors to use this data instead of making decisions that are very biased or just let's say based on tips or instinct. I think data-driven analytics is the future, and I mean it's already happening, right? We're already there.
What I also like to say, that people need to put a bit of time and effort into doing, if they want to do it themselves and not go to, because it's the truth, there are people who don't go to advisor, they want to do it themselves, but in that case they shouldn't just get jump into it, but take a bit of time, do homework. There are so many tools available, so they can use and learn more about what they get into in terms of risk and what they expect. Does it align with themselves and their needs or not? So in a way, doing what an advisor would do, but you need to take the time, because advisor takes time, and this is why they charge, because they take time to understand you and your needs and propose something. So you need to take time to do it yourself better with the use of technology, if you want.
Absolutely. And even though you may be very tech savvy, or you may actually use different tools to create portfolio management yourself, there are going to be times and periods where the market is actually very volatile, and you may just not have the time to look at it due to personal reasons or due to your workload, and that may be the most important time where you need to do something. And if you miss out on that, right, then you've essentially lost a lot of data, right? We did a research in the Indian markets, and essentially if you missed, let's say, just around 30 to 40 days in a very long span, you missed bulk of the return. Right? Just a few days accounted for most of the upside. And those are the times, for example, in the past 6 months, how to what's the strategy in the market? What do you need to do if you would want to add funds? When is the right time? Is a higher rebalancing frequency required? Do you need to shift from a certain factor, let's say from a momentum factor to a quality or value, right? And let's say from a category perspective, small to large, mid to large, right? These decisions are a little bit tricky to take. Of course, passive investments, where people who do index investing,
just sleep on it.
And it has its own pros and cons. But if you're seeking active advice, right, if you're seeking to generate alpha over the indices, these are the things that you may have to do.
And this is something we want to highlight as well, that for professionals and fund managers, portfolio managers, again, it's very important to use technology, because it's a strong competition in the market. There are so many funds, so many portfolios. Everyone is chasing clients in a way.
Right.
So you want to produce that extra alpha. You want to be better, even
Absolutely.
by 1% extra.
Yes.
So it's not just enough to create a portfolio, well researched and so on, but you always want to keep on top.
Right.
And when the discussion of how often you rebalance, you optimize and so on, again, it just seems easy, but it's not, because you don't know, different portfolio have different frequency, which is best for them. So that's another area of research we're doing now, but it's not black and white. So
right, absolutely.
Again,
interesting. Yeah, no, absolutely interesting. So I think to summarize, we have different tech available for investors and fund managers, which they can leverage to enhance their own practice, right? And some of our collaborative portfolios, right, for investors in Australia who would like to invest in different markets, right, and primarily have, let's say if it's an Indian market, we would be having curated baskets for such investors where they can just sort of, have an account opened or have someone do the execution for you, and you essentially just have to sit back and just tell us if your risk profile changes, right? So just give us the analytics and more details about yourself, and we'll find the right portfolio and basket for you, right? So managed portfolios is what we're trying, right? Sounds good. I think we've covered nice discussion. We've covered several points, and highlights being that data driven investments, portfolio analytics is drastically changing. It's getting more and more powerful, and if you truly sort of know in which direction to look at or make the best of it, it can make a huge difference to your personal finances and sort of save a lot of time from, let's say, your investment horizon, your retirement planning, and various other aspects. And I truly believe that investors, fund managers should use this to their benefit, and perhaps we can assist them with that. Yeah, sure. So because what we offer is complementary, really. Right. So it's a good way to collaborate, and anyone interested can contact us, and we can work together. Right. Absolutely. Cool. Thank you. Yes. Thanks a lot. Thank you very much.